Thank you, Spiros. It's a pleasure to be here, and I thank Kostas, Spiros, the whole committee for having me in, and thank all of you for attending. To understand what might be next for OPEC next week when they meet, it's helpful to have a clear picture of what the current situation is. And I do think there's much misunderstanding and confusion about the current situation. So I'm going to really start by trying to describe, in my own view, where OPEC stands versus the market. And then we'll go on to consider, maybe not predictions, but at least some thoughts about the future decisions OPEC will make. I have two versions of this presentation. I have a short one, and I have an even shorter one, which is so short I'm going to give it first. And that is to remind you that I come from Texas. My university is in Dallas, Texas, and on behalf of all those Texas shale oil producers, I want to thank OPEC for their continued efforts to shut in production, protect the price, and generate Texas profits. We appreciate that very much. On the other hand, I cannot imagine how that course serves the interests of OPEC, or particularly Saudi Arabia. So that's the short version of my presentation, and now I want to really move to a little bit more analytical discussion of the reasons that have taken me here. So what's the problem with OPEC today? If you read the trade press or even the general press, you've got an idea that OPEC is having a limitation on its market power. It's in a market share trap. It can't command the power that it used to have. And more on that, of course, the problem is if they raise the price too high by shutting in production, then they lose so much in sales that on balance they lose revenue, which they don't want to do. And they don't have perfect information about this price and demand, and so the only way they can try to find what is their best price is through trial and error. I think this is a perfect description of what we've been seeing for the last 2 years or so of OPEC, but this is not a new prescription. This is something that my old professor, Maury Edelman, wrote back 25 years ago about the OPEC difficulties then. In my view, almost nothing has changed in 25 years. People talk about the new era in the global oil market and the new version of OPEC. To me, it seems like all old news, but very well worth reviewing. So I want to think about now what OPEC's decisions entail, because I do think they have sacrificed a lot of wealth. We've gone through the era of peak oil, and now people are discussing peak demand. I think OPEC should focus on peak wealth. I think that over the last 25 years, they've committed many strategic pricing errors, and they're continuing to make those pricing errors. The price got too high too soon, and this has substantially decreased the value of their resource asset, the value of their minerals. And so peak demand, you can talk about when demand will peak, but the real focus, I think, should be on whether or not oil in the ground is appreciating as fast as money in the bank. And if it's not, better to put the wealth in the bank than to keep it in the ground. To bolster my argument that OPEC has kept too much oil in the ground for too long, I want to begin with the analysis in Modena. I'm sure everyone here is familiar with Modena. It's a great city. It's known for many things. This isn't a Tesla. This is the real thing, the Ferrari. This is also the real thing, Pavarotti. But here is the real thing, and that is the balsamic vinegar. All of this produced in Modena. If you focus on that third bottle to the left, it's kind of the intermediate sized one, I want to pick that one out because it's a bottle of balsamic vinegar. After it's produced, it's aged in oaken barrels for 4 years. And that enhances the flavor, it intensifies the sensation on the tongue. It's a good thing. Now, there's an even less common version of the Alessis balsamic vinegar, and I have a bottle of it right here. It's a brown bottle. The difference is that this one is aged 20 years in oak barrels. It starts out the same. They just kept it in the barrel 16 more years. You're familiar with the single malt scotches. You understand how that can enhance the value of the product. And in fact, it does in the case of the vinegar. If you look at pricing in my market back in Dallas, I could buy the 4-year-old for $3.69 a bottle. And this bottle here, the 20-year-old, costs $12.99. So it must be better, right? If people are willing to pay that much more for the enhanced flavor. And they better be, or else the lessees have been making a big marketing mistake. Because if you think about their intertemporal receipt of revenues, the arbitrage, they have a decision to sell the vinegar when it's 4 years old, which will bring in $3.69, or they can keep it an extra 16 years in the barrel, doing nothing, and sell it for $12.99. The present value of the difference is exactly zero. That is, they have the same value whether they keep it in the barrel or not. And if they didn't, then they should be producing more, taking more out now, or leaving more in for the future until they get this arbitrage working correctly. And at an 8% discount rate, it looks like the lessees have sent their children to business school. So congratulations. It looks like the Saudis have not, although we know they have. In fact, the Crown Prince was to Wharton. So what's up with that? As of 2015, people, when the oil price cratered, people were suggesting, okay, OPEC, Saudi Arabia, you should shut in production and defend $100 a barrel. Cut production enough to support that price. You would get $100 per barrel now. But then, of course, you would have shut in some production that you won't monetize until many years later. The Saudi reserve production ratio would be something like 35, which means that they wouldn't actually monetize that barrel until they could produce it into the market, say 35 years later, in 2050. They could have gotten $100 per barrel if they had cut back production in 2015. But to justify that, I'm saying they would have to expect to get $1,400 per barrel when that oil eventually comes out of the well. And why do I say $1,400? It's the same arbitrage argument. Here I'm assuming a $5 lifting cost for the oil so that the $95 net revenue from immediate production is equal to the present value of the margin when that conserved barrel is ultimately produced. So, you know, the lesson is if you don't think oil is going to get to $1,400, then you should be producing more now. You're wasting your asset, you're losing value by not increasing production. So now the Saudis and OPEC are meeting, and a lot of people have talked, at least indirectly, about maybe a price target of $60 a barrel. How does that muster against the standard? Well, $60 now, present value of that, would require the price to rise to $700 per barrel in the future in order to justify maintaining production at the level to defend $60 today. Will the price get to $700 within the next 35 years? I don't think so. We don't know how much demand is going to be left in 35 years, but probably at that price, close to zero. Maybe not zero, but close to zero. So there's this longer run perspective, and it's very clear that in the short run, OPEC has had fun with high prices. You get the revenue, you get to distribute it to your population, you get credit for the infrastructure that you can develop, and that's good because the reactions are subject to rigidities. We know that demand and supply is inelastic, but in the long run, they're not. And in the long run, most of the implications are negative from the high prices due to the reactions, both on the demand side and on the supply side from non-OPEC producers. So the long run has carried many negative potentials, and the long run has now arrived. As of 2014, November, I think we could declare the long run consequences irreversibly arrived for OPEC. And for that reason, I think OPEC hasn't lost its market power. It can still affect the price. It depends on how much it wants to produce, whether it wants to develop additional capacity or shut in capacity. But it makes sense to try to defend a lower price because the balance of supply and demand has shifted due to the rise of shale oil In addition to the exploration of other high-cost frontier areas that wouldn't have been possible or attempted if price hadn't gotten to $80, $100, $120 a barrel and stayed there long enough to initiate these alternative investments. Some people looking to the future, and we've heard projections here even this week about the attempt that the European Union is going to make to reduce emissions, to decarbonize. There's some fairly strong measures proposed that need to be converted into legislation. Some people may doubt that that would have any effect, that consumption will continue, demand will grow. The Saudis will be able to sell their oil for $1,400 at mid-century. Maybe that's true, but I doubt it, because demand does react to price changes. It does react to policy. And I'm going to go back now even further in my history, 1974. This was just after the Arab oil embargo had tripled oil prices for U.S. and other customers. The Ford Foundation in the U.S. conducted this study. This is the cover of the book, A Time to Choose, and it laid out different paths and suggested different policies that would control the projected increase in total demand in the U.S. This was a projection. You go back to 1970, that was the data point, but it was anticipated that total demand would triple in the U.S. for all forms of energy, essentially over the next 30 years. And given the perceived scarcity of oil, that looked unsustainable. So the Ford Foundation said, well, here's what we can do. We can impose efficiency standards on appliances. We can impose efficiency standards on cars. We can regulate more forms of energy. We can mandate conservation in a number of different areas. And if we do all of those things, they projected that it would cut demand substantially in the U.S., according to the red line. And they said, well, gee, maybe that's not even sustainable, so let's go for a zero energy growth by imposing more stringent measures of these types. And that gives us the green line, which they called zero energy growth. Now, I think if you tilt your head enough, that'll look like zero energy growth, or at least it's close enough for government work, even though the Ford Foundation was not the government. But the thing is that those policies were recommendations from a think tank. Most of them were never adopted. The ones that were adopted were kind of watered down. And those that were adopted were also circumvented. In the U.S., people started buying pickup trucks that could have big engines and very inefficient performance instead of cars. So you would think, well, that's unattainable. What really happened over that period? That is U.S. total energy consumption over the period of concern. Dramatically decreased, not because of policy interventions, but because of the market. The price went up. People adjust their behavior according to prices, according to incentives. And so we can have very dramatic shifts, unexpected shifts in demand and in supply, and they're triggered by sustained price changes. And this is one factor, I think, that OPEC needs to keep in mind. We're not on a trend line where demand is always going to grow necessarily at 2% per year, independent of price, independent of other sources of energy. So maybe the lesson was learned too late. I think it was. If OPEC doesn't expect the price of oil to reach $1,400 by year 2050, then they should produce more now. They shouldn't continue try to defend the price by having this coordinated freeze and cutback at the current level. That doesn't make sense. But to produce more now, they're going to have to accept lower prices. But the demand curve, we all understand that. Substantially below $100 a barrel, and I think substantially below $60 a barrel. And they would even have to expand investment in new capacity to achieve the full net present value wealth of those resources. People talk about stranded assets. I don't think the oil will necessarily be left in the ground, but if the Saudis are selling oil in the year 2050 for $100 a barrel, that would be a disaster. They could have done much better in managing the resource wealth than that. Present value of that sale would be $5 by today's standard. Doesn't make sense. So my old professor, Maury Edelman, again, was fond of saying OPEC's job was kind of like singing and mountain climbing. It's a lot easier going up than coming down. And we've seen this bumpy coming down path and this search for a strategy We've seen OPEC groping now. I can't imagine why they felt it would help them, their cause, to reduce production, freeze it, to accommodate shale oil, to allow the profits to flow to Texas rather than to be commanded by OPEC. But they've made that decision. It seems like they're going to renew it next week at the meeting. So I think the lesson maybe hasn't been fully learned. 2 years ago, I thought it had, when the Saudis said, okay, we're going to go for market share, we don't care. But, you know, the regime turned over. There's been a change in strategy. I don't think we should be fooled by that. The market will determine the price. I wouldn't be investing in capacity that required more than $60 to make a return on investment. Now, this isn't just a new view that I've adopted in the last 2 weeks or 2 years. This is a verbatim chart, the facsimile of a chart that I presented back in 2005, where I was attempting to model OPEC revenues in the context of world oil demand and supply, to see what would be the consequences for net present value of net revenues to OPEC as a group if they defended prices of $30 or $45 or $60 over the long term. And you can see that by the assumptions of my model, that the maximizing price for wealth was around $55 per barrel back in 2005, which was a little higher at that point, but it was in the neighborhood of what OPEC was doing. We know that they let price fly up to $120, $140 per barrel for some time. And that's exactly what you wouldn't want to have happen here. Right? Why does the wealth come down if you get above $60 here? It's because high prices trigger conservation, reduce demand, and they trigger technological innovation, which erodes further the net demand for OPEC oil. And that's exactly what happened. Without $120 oil, we wouldn't be fighting against shale oil production and reserves today. That never would have been attempted. We never would have had the experimentation. But we did. And now it's too late to put that back in the bottle. This analysis actually distinguished between the individual OPEC members because they're not all alike, as you know. Saudi Arabia has massive reserves, and it has also the burden of, in defending a price, it tends to have to cut back more because there's a bunch of cheaters out there that always exceed their quotas, okay? And so if you look at who that wealth accrues to, if you try to defend $60, turns out that it's not the Saudis. Here I've broken the wealth down into 3 groups, and the Saudis is the blue line. The other core producers, which would be Kuwait, the United Arab Emirates, and Qatar, are the red line. And then the fringe producers, by which I could also refer to as the cheaters, which includes Iran and Venezuela and Nigeria, and everybody that pretty much produces all they can, as much as they can all the time. Both of those 2 latter groups would benefit by $60 per barrel, but the Saudis would not. And so there's a compromise. For OPEC to agree on any price point, they have to compromise because of the differences in their reserve holdings, the differences in their costs of production, and the differences in how the market quotas get allocated in reality, if not through diplomacy. So my bottom conclusions here, and this is the last slide really, is my conclusions have not evolved hardly at all through everything we've been through over the last 12 years. I think the current price represents a broad compromise among the different members of OPEC. They have conflicting interests, and they have always managed that compromise by choosing a price that I think has not been to the Saudis' advantage. It's been on the high side. If you kind of divide OPEC into price hawks, Iran, Venezuela, and price doves, that would be the Saudis and maybe Kuwait. They have to come together on one agenda, and it's been the Saudis that have been making the compromise until October of 2014, when I saw the Saudis stand up and say, okay, compromise is over. We have to look after our own now. Our population is growing. We can't afford to make the sacrifice of wasting this mineral wealth. And so the Saudi tolerance for a high price band, for something like defending $60 or higher, I think is going to be very limited. And unless there is very strong discipline that would involve the other members to cut back their share substantially, so the burden doesn't fall so heavily on Saudi Arabia. And even to ensure that Russia perhaps joins that cutback. But I don't think those things are likely. I think OPEC is OPEC. It hasn't really changed its personality over the last 40 years, and it's not about to. So if the Saudis want to defend a higher price, they're going to take it in the teeth. They're going to be the ones that have to continue cutting. All the while, the shale oil producers are drilling more wells, putting more of that light sweet oil in the market, and forcing that price down. So I thank you for your attention, and we will see next week whether there has been any change, if the tide is coming in or going out. So thank you.